XRP hit an all-time high and you might be the richest you've ever been. You got in early and want to benefit from some of the fruits of your labor and cash out. You should wait. Give me 10 minutes and I'll give you 5 tips you need to know as a crypto CPA that has helped my clients collectively save over 10 million in taxes. Let me briefly explain how crypto taxes work. When you cash out XRP that has gone up in value or swap it for another token, you trigger capital gains. Capital gains are either taxed as short-term gains if you held your crypto for under 1 year or long-term gains if you held them for over 1 year. The IRS taxes your long-term capital gains at either 0, 15, or 20% depending on your income. On top of that, you'll pay state income taxes and an additional 3.8% net investment income tax for high earners. High earners in high tax states could definitely be paying over 30% here. Short-term capital gains are taxed at higher rates. This is taxed alongside the rest of your ordinary income, which could range anywhere from 10 to 37%, in addition to your state income taxes and the 3.8% net investment income tax for high earners. High income individuals could be looking at tax rates of over 50% if you are in a high tax state such as New York or California. Now, the IRS has put front and center on the first page of the tax return a question of whether or not you traded cryptocurrency during the year. When you file your tax return, you're signing under penalties of perjury that you filled out the tax return truthfully and to the best of your knowledge. Therefore, if you cheat on your taxes, you risk the IRS sending you to prison and assigning you a new boyfriend named Jerome. So if you don't want the government to take over 50% of your gain here, what do you do about it? Well, the first things you want to do are avoid common accounting mistakes that lead you to overpaying in taxes. Because the more trading volume you have during the year, the more complicated your accounting is going to be. As obvious as that sounds, if your trading records are a mess, you're likely going to over-report the amount of gains you had during the year. You need a crypto accounting software. This will automate the time it takes to put together accurate records, but that doesn't mean it automatically does a good job. You need to put in time or pay someone to and know what you're doing so that all of your cost basis is captured and you aren't reporting more in gains than you should. So what do people usually miss? Well, they don't connect all their wallets and exchanges they've ever used. Because if the software can't follow the complete trail from the time you purchased to the time you sold, it won't know what your cost basis is and a lot of the time leave it at 0. Meaning the entirety of the price you sold at would be the gain if you handed these records to your CPA. Next common miss is they don't classify transactions correctly. Deposits into a wallet of yours sometimes will get marked as income instead of as a transfer from one wallet to another. You need to make sure that the software is not reporting income here that isn't actually income. And sometimes transfers from some exchanges don't integrate with the software smoothly. You need to upload all historical data. If you bought Bitcoin in 2017, this matters when you sell it in 2025. Another common miss is not catching duplicate transactions. Long story short, incomplete data means you'll be giving your tax guy records of phantom profits that didn't actually happen. Crypto accounting gets complicated fast, and it's probably a lot easier to have a professional like our team at Altcoin Pro handle this for you. Now that you know you'll have accurate records, you need to have an actual strategy and start working on this before the year is over, not after. Next is tax loss harvesting. You may have had coins that have gone into the dump and they're worthless. You may have invested in NFTs years ago that you completely forgot about. You may simply have investments that have gone down in value. If you're going to cash in on gains, you should also lock in the losses that you have incurred so you offset some of those gains. But when it comes to crypto specifically, this strategy is even more important. The IRS does not consider digital assets like crypto as securities. Instead, they consider it property, similarly to real estate or other hard assets. There's rules in place to prevent people from selling their securities to lock in a loss and buying them right back. But those rules don't apply to crypto, so you can legitimately lock in all your losses before the end of the year by selling the portion of your portfolio that has gone down in value and then simply buy it right back if you choose to do so. Number 3 is don't mess around trying to get involved with offshore or risky tax strategies. Whether you set up offshore entities or trusts to hold your crypto, or you're simply attempting to hold it on foreign exchanges because you heard some advice that it helps you avoid US taxes, unfortunately, it does not. The US taxes US citizens on all their income, regardless of where they earned it. Not only does this not save you any taxes, it also just increases your costs significantly, now having to deal with lawyers and accountants in other countries, without seeing any savings here. Additionally, the Financial Crimes Enforcement Network, FinCEN, released a statement that crypto would need to be reported on the FBAR, Foreign Bank Account Report, by US citizens in the near future. If this becomes law, you now have new forms to fill out and deadlines to follow, or you are at risk of huge, upwards of 5 or even 6-figure penalties for not complying. Next is choosing your accounting method. When reporting your gains, there are a few different methods of accounting that will affect the amount of gains you report in a given year. The major methods you should be aware of are FIFO, LIFO, HIFO, and specific identification. This is important because as you accumulate more crypto, clearly you are not buying in at the same exact price each time. So when you sell, depending on your reporting method, you are either going to be reporting that you sold your assets that you bought at a cheaper price or more expensive price. Now LIFO means last in, first out. FIFO means first in, first out. And HIFO means highest in, first out. Specific identification means you are specifically identifying the purchased coin as the one you sold. If your crypto is held with a centralized exchange such as Coinbase or Kraken, when you sell an asset, they will automatically report the gain as FIFO, meaning the crypto that you sold is the oldest that you bought, unless you specifically choose a preferred accounting method. That typically assumes that you are reporting you sold the crypto that was a lower value at the time you bought it, meaning the gain you're reporting is higher. So if you don't want to be reporting the maximum gain you can every time you sell a crypto, first, you're going to want to change your accounting method, or at least have a strategy for doing so. Maybe you know next year will be a higher income year for you because you're getting a new job and therefore your tax rate will be higher. Well, then maybe it makes sense to report the lower cost basis and therefore higher gains this year, so that next year your gain is lower while you're in the higher tax bracket. In that case, maybe FIFO does make a lot of sense. Maybe it makes sense in the case that your FIFO basis units will be long terms and your LIFO will be short term, making a big difference in tax rate. Maybe you'd rather pay less taxes this year so you have more cash to invest. In that case, you want to choose HIFO or LIFO, or specifically identify the purchased coin as the one you sold, so that your gains are lower this year. Regardless, you need to make sure that you have a strategy, and that strategy is decided before you sell, so that the exchange does not automatically assume FIFO. We actually discussed this quite a bit in our Crypto Tax Mastery course, which you can access by joining Altcoin Pro in the link in the description. And fifth is avoid penalties. The IRS requires you to pay estimated taxes quarterly, or else they assess penalties. Now you're making these estimated payments before you even know what your tax bill for the year is going to look like. If you cash out big before the end of the year and you haven't been making the proper estimated tax payments throughout the year, you could be setting yourself up for some tax penalties. Now, so long as you've paid at least 110% of the amount in taxes that you had last year, you'll avoid these additional penalties. However, it still is a huge consideration before you decide to sell off. There are plenty of things you need to consider if you want to minimize your tax burden when selling off your crypto. You deserve to benefit from your investments, and to be ashamed to have to give over half of your money to the government simply because you did not have a proper plan in place. Overall, there's plenty of things you need to consider if you want to minimize your tax burden when selling off your crypto. You deserve to benefit from your investments, and to be ashamed to have to give over half of your money to the government simply because you did not have a proper plan in place. So let's protect your wealth together. Book a call below if you want to discuss this further. With Altcoin Pro, I'm Anthony Price, CPA. See you in the next video.